Hi, Chris Camburn here with Annuity Nest, and it's late October 2022. Exciting times for fixed annuities, as you may have seen if you're looking for highest annuity rate or best annuity rate. 5-year fixed annuities are now back above 5%, and it's been a very long time that we've seen these. So in this video, I'm going to go through a little bit of what I call a fixed annuity buyer's guide to help you find what's the best rate for you, the highest rate for you, some tips and tricks, things to know. First, let's run some compliance disclosures, and we'll be right back. All right, that was exciting. Welcome back. So let's get into it. What I have up here is I created a little bit of a Word doc to help you understand what to look for, maybe give you some questions to ask. How do you find the best rate, the highest rate? And is the highest rate the best rate? Well, maybe so, maybe not. Let's look. So when you're looking at fixed annuities, things to consider, obviously, you want the issuing company and contract name, and then also the company rating. Annuity companies are rated on a scale from A's being the highest with pluses and minuses along the way, or AAA being the highest, AA, then single A, with some plus and minuses depending upon the rating company. And you want to know the safety of the insurance company that you're with, because the guarantees that annuities provide are only as good as the claims paying ability of the insurance company. Yes, there's state funds and all that, but you don't want an insurance company to go insolvent and not pay you. So you just don't want to be involved with that. And in that case, there's still no guarantee that the states will give you back all the money. Your investment is only as good as the insurance company, but there's a rating schedule so that you can help determine the creditworthiness of the company that you're giving your money to. And with fixed annuities, are there any fees or costs? Typically, no. Fixed annuities don't have fees and expenses like variable annuities or mutual funds, and they typically don't offer optional riders, which then come with fees or expenses associated with them. The only thing I've ever seen, there could be a $50 a year contract fee if your account value is below a certain amount, $50,000 for instance. But that's about the only fee I've ever come across with fixed annuities. And then you want to know, hey, what's my rate? And there are different rate term options. Understand you can buy a fixed annuity anywhere from 1 to 10 years, the most common being 3, 5, and 7 years. And when you hear the rate or you see the rate, you want to know, is the rate a multi-year guarantee or is it traditional? Multi-year guarantee means that it would be, for instance, X% for Y years. Right here, say 5.2% for 7 years, right? That is a multi-year guarantee. For multi-years, it's guaranteed. Now that's in contrast to what's called a traditional annuity, where it could be, say, X% for Y years and then Z% for some amount of time thereafter. So for instance, 6% for 3 years, 3.5% for 2 years, and then a 1% minimum. So you might see a headline rate of 6% annuity, but you have to do some math to figure out if 6% for 3 years and then 3.5% for 2 years is better than, so it's 5 years, is better than 5% for 5 years. I mean, this is how the highest rate may not be the best rate, or the best rate may not be the highest rate. So these are things to know. And I don't know if it's tricks from annuity companies or because buyers have wanted flexibility. I sense it's a combination of both, salesmanship and customer request. But just understand. And then you also have to ask, what's the minimum rate? So for instance, if you see 5.2 for 7 years, and I'll talk about this no withdrawals, 10% withdrawals in a moment. 5.2 for 7 years, after 7 years, what happens? Well, if while you're waiting to redeem your money, you might earn a 1% minimum, 2% minimum, 3% minimum. Typically minimums around 1% now. They used to be 3%, but then insurance companies learned that 3% is too high of a minimum. And so you just want to know what the rate schematic is. And let me do this one next. Insist on an illustration. Meaning if you're going to put money in, ask the company to show you an illustration. It's sort of, it's not a contract and it's not guaranteed, but the illustration shows you on that day when you've asked what the rates are, they'll show you what the rates are and they'll show you the projections of how your money will grow or perform. All right, so an illustration also helps you if you're looking for multiple companies. You can put them side by side. If it takes you several months to get around to actually buying it, you can look back to see what the rate was and then what it is currently. And what this rate lock is, that has nothing to do with from when you've asked for an illustration to when you finally buy the annuity. A rate lock is during processing. Once you've agreed and once you've sent a company a check, these companies right now are swamped with annuity applications. It's the busiest time I've ever seen for fixed annuities. And so if you're going to get 5% for 5 years, ask your company if there's a rate lock. And that means that from the day they get your money, if the rate's 5% on the day they get your money, and it takes them 2 months to process, and rates drop down to 4.5, just make sure that they will honor the rate that you signed up for on the day you signed the paperwork and got them a check. Typically, it's based upon when they received your monies, and your application is in good order. See if they can lock the rate, or sometimes they'll even honor an increase. Yes, if it takes us a while to process, we'll give you the greater of what you started with, or if things have gone up better. And sometimes we'll say we'll give you meaning that they'll never drop the rate from what you initially signed up for. Just make sure that's the case. All right. Sometimes there's minimum purchase amounts, say $1,000 or $5,000. Now, personally, I wouldn't get involved with one of these things for less than $25,000. There's so much paperwork, and really, it's just not worth the time and effort for smaller amounts of money. There are also maximum purchases. Sometimes an annuity company will say, "Hey, listen, we'll assume the risk of $2 million on one person." I mean, they're ensuring that what happens is when they go out they have costs. They have costs behind the scenes in structuring these annuities for you to give you these rates. And if there is, mostly in the instance of death, they guarantee premiums to your beneficiary. So if you give them $2 million and interest rates go up after 1 year, the bonds they hold are down, they have risk of your passing. And so they really don't want more than, say, $2 million of risk for any one life. I have seen some carriers offer as high as $5 million. There are exceptions. You can call in. You can have your rep. We can call in and request exceptions. Exceptions are made all the time, but they're not guaranteed to be made. And just know that sometimes there's maximum amounts you can buy too. There are also break points, I should say, maybe rate break points here, because sometimes if you give them more than $100,000, you get a higher rate than if you give them less than $100,000. If you give them more than $250,000, you get a higher rate than if you give them less than $250,000. There's also something called a surrender charge period, or there's a market value adjustment. Call this a penalty for redeeming your contract early. If you give someone $100,000 for 5 years and you hold your contract for 5 years, there are no cost, fees, penalties to withdraw all your monies and interest after that 5-year period. However, in the interim, during those 5 years, there's something called a surrender schedule or a market value adjustment should you request monies from a carrier prior to the end of the term. And here's a sample surrender schedule. Say for that 5-year annuity I've been referring to, a surrender schedule could be redemption charges of 7%. That 7 is a percentage. 7765. These are percentages. These are percentage penalties if you take out monies within that year. So in the first year, it could be a 7% surrender charge, think penalty. In the second year, 7. In the third year, 7. In the fourth year, 6. In the fifth year, 5. A different company may offer a different surrender schedule, 7, 6, 5, 4, 3. I'm just suggesting that you know what the surrender schedule is, and the surrender schedule is known. If you give someone $100,000 and you take out $10,000 within the second year, the surrender schedule only applies to the amounts you withdraw. So if you give them $100,000, it's not a $6,000 penalty unless you take all of your money. It would be a $600 penalty because that's 6% of a $10,000 hypothetical withdrawal. In the third year, say that's $500, $400, etc. And depending upon the length of your contract, a 7-year contract has 7 years of surrender fees, but it might have a higher rate. So you may want to just have a 7-year contract because you don't expect to take money out. Now a surrender charge is easy because it's a percentage applied to your withdrawal, and you know today in year 3 how much it's going to cost you to redeem a certain amount of money. The market value adjustment it's also a penalty, but it could be a charge against you or it could be a charge in your favor. It's a formula. And it's one of these formulas where I know all the variables, you know all the factors, but you don't know the amounts of the variables and you don't know the amounts of the factors. So it's this formula. It's a little bit much to get into for the sake of this presentation, but just know that, again, you could get back less prior to the end of the initial contract term if you make a withdrawal. Now, there is an asterisk here. A lot of contracts have what are called free withdrawal amounts. And what that means is that you can typically withdraw, say, 10% of your cash value every year after the first year. And it's on a contract anniversary. So if today's October 26th, that's the beginning of your contract anniversary. It's not a calendar year, it's a contract year. So many of these carriers will allow you to take out 10% of your cash value in any given contract year after the first year. Some allow you just to withdraw interest. Some don't let you take anything. And then on these 10% withdrawals on your contract year, it's normally, there's no cumulative credits, meaning if you're 3 years in and you've never taken out money and you have to make a withdrawal, you don't get 30% of free withdrawals. It's 10% a year, use it or lose it. You could use it to your advantage, as we do here sometimes, or it could work against you if it's something unexpected. Again, the goal here is that you're aware that there are surrender charges if you need your money prior to the end of that initial term. There are minimum issue ages, typically age 18, and there's maximum issue ages, age 80, 85, 90. So if you're getting up there in years and you like these contracts, just be aware you might have to look around until someone has a contract that they'll allow for your age. And on these, I missed something here, waivers on these free withdrawals. It's sort of like a hardship provision, if you would, please, if I can use that term. For different reasons, they'll allow you to take out more than 10%. It's not a reason you're going to, it's only because something adverse has happened to you, not because something good has happened to you. So death, disability, hospitalization, nursing home, admittance, terminal illness, unemployment. I just understand that if something adverse happens to you, there's a very good chance you can receive all of your principal back prior to the end of your term. And also there's some of these do offer return of premium, whether you have a hardship or not. Some carriers just allow you to take all your money back no matter when, but you'll typically see they come with a lower rate than someone who does not allow you to take your money back or for whom only allows 10% withdrawals. You might want to know if annuitization is an option. That's when you forfeit your money to the insurance company in return for lifetime payments or payments for a period certain. It's not a very popular feature. I've never used it on a fixed annuity for anyone, but just know that you can, that's the classic, like, well, people have concerns, oh, I don't want to buy an annuity because I don't want to forfeit my money. Well, I guess there could be some misconceptions. If you think forfeiting your money for 5 years to get 5% is a forfeiture, it might just be semantics. I don't think that's a forfeiture. I just think that's tying it up. Forfeiting it is when you give someone $100,000 and you say, you keep the principal, just pay me back interest over time. That's annuitization. Actually, they're paying you back principal and interest over time. That's annuitization. It's the only time you forfeit money in annuity, and you, for the most part, cannot get your money back. Severe penalties. Again, too much calculation for the sake of this presentation, but annuitization is when you give the insurance company your money and they pay you income for your lifetime, you and your spouse's lifetime, or for a period certain. And that's the only time when I would consider that it's a true forfeiture of your funds. Now, there are some basics to know, or I guess some commonalities in these annuities. Typically, the more rigid and less flexible your annuity, the higher the rate. So the less withdrawals, the less additional premiums you can put in, the higher the rate. The longer the contract, the higher rate. Less liquidity, higher rate. Higher the insurance company's rating, the lower the rate. And typically, if these contracts are one and done, once you submit your funds, you can't put more monies into the contract. And if you do, those additional premiums, those subpays, would get a different rate, a lower rate, a lesser rate, a less amount of time. Not certain if you have to ask if additional premiums would be grandfathered into the first premiums, surrender schedule, or if it resets. I mean, if you're in year 3 of a 5-year contract and they let you put in more money, do you just have 2 years left to get all your money back unencumbered? Or does that additional premium have to wait 5 more years and reset its own surrender schedule? It would never reset the initial premium surrender schedule, but does that additional payment have a 5-year surrender schedule or just to the end of the initial 5-year period? You follow me there? So these are things just to know and just to be aware of as you search for best annuity rate, highest annuity rate, or fixed annuity rate. Now on my website here, annuitynest.com, I do put brochures and information for all the fixed annuities and all the annuities we carry. So as to not favor or provide preferential treatment to any one carrier, we simply list them all. And you can go, and if you see something that has a fixed annuity category and has a 4 or a 5 or a 7 or a 3 or a 10 after it, you can know that's the amount of time you have to hold the product. You can read the brochure. The one thing you won't see here is a rates column. Rates change every day. Rates change every day, and it's just too difficult to put that on the website. But there is still good information on the site that you can go to. So through Annuity Nest, and if you click on annuity companies, you'll get to the site that has the information about each different carrier. So as you see rates out there, best rate, highest rate, understand a lot more can go into it than just the headline. And in the links below, I have links to some of my guides, retirement planning guide, tips and tricks for 2021, very similar to what it would be for 2022, financial planning guides. So if you're looking for more information on annuities or financial planning, feel free to click the links below and hope to see you back here real soon. Thank you.